Hey guys, welcome back to the channel. So today I'll be reacting to some clips from a recent interview by Mohnish Pabrai, and he shared a really interesting story about one of the all-time great investors that you might not have heard of, a man by the name of Rakesh Jhunjhunwala. Rakesh was an investor based in India, who sadly passed away just a few weeks ago. And Mohnish tells a great story about his insane investment journey, and how he went about accumulating his wealth. When Rakesh started out, he essentially had no money, and when it was all said and done, he turned a $25,000 loan into around $4 billion. Mohnish describes Rakesh as sort of a split brain when it comes to investing, as he did a lot of rapid fire trading as well as regular investing. But the biggest driver of his gains essentially came from buying and holding two great businesses, which went on to become massive multi-baggers. So that's the topic for today's video, and let's get into it.
Recently, there was a lot of coverage about an Indian investor, Rakesh Jhunjhunwala, who just passed away. I didn't know him, but I have friends who are close friends of his. So he's kind of a friend of a friend. Rakesh was 62 years old. He was in poor health. He passed away with a net worth of over $4 billion. All of it was from the market. And he never managed outside money. I mean, if he had decided to open an investment advisory business, billions of dollars would have come to him. But he wasn't interested in that. So he just managed his own money. And when he first started, he's a chartered accountant, a CPA. When he first started, maybe in his early 20s, about 40 years ago, he had no money. He had absolutely like zero. He went to this lady and requested her to give him a loan of about $25,000 so he could buy some stocks. So the lady told him, if I give you this money, what is the guarantee? What guarantee can you give me? What collateral will I get? So he said, look, the only collateral I can give you is my signature. I have nothing else. I have no assets. So you should only give me the money if you trust me. So she didn't fully trust him because he's an unknown guy. But she tells him, okay, listen, here's what you do. You take the 25,000. I'm going to first give you 12,500. You go buy stocks with the 12,500 and then you give me those shares. I will hold custody to those shares. They are your shares. The upside belongs to you, but that's my security. So he said, done. He also agreed to pay her 18% interest for the money, which is, I would say this was a different time, probably early 80s. Normally in India, you would borrow at 12, 13%. Rakesh paid 18%. And then, he started to invest, and he was I would say he was a split brain. He did a lot of rapid fire trading, but he also had two really long-term holds. So there's a company in India called Titan Industries, which I think he invested in maybe 20 or 25 years ago. And when he made that investment in Titan Industries, it was like 3 or 4% of his portfolio. He never sold a share till he died. He died with those shares. And out of the 4 billion, around 2 billion was Titan. And Titan compounded at something around 30% a year, 30 or 35% a year for more than 2 decades. And actually, if you study Titan, I don't want to go off track because your members won't have much interest in studying Titan. But if you study Titan, basically, it's a jeweler. And in India, the only jewelers you would do business with was ones that your family had done business with for a long time. So you could have some trust. Because, when you're buying gold, you don't know whether it's fake or real or whatever else. Titan was, it was promoted by one of the large Indian conglomerates who was very trusted. And so they had natural trust. Indian jewelry was very fragmented. And now Titan is gradually consolidating that. It's, in my opinion, Titan still has maybe a 50-year runway ahead of it. It's got a huge runway ahead because it's so, but to give Rakesh credit, company went through lots of ups and downs, but he understood the business. And when it became 10, 20, 30, 40, 50% of his portfolio, he was least bothered about it, just kept it. And then there was another company, Lupin, which is the pharmaceutical industry. And I think Lupin became 25-30% of his book. So he was doing a lot of rapid fire trading every day. He had 3 screens in front of him and all of that. And he'd buy stuff at 10 o'clock and sell it at 2 o'clock, whatever else. I think that was just to keep his mind occupied. Okay, very smart guy. But these 2 stocks, with the guy who's doing this rapid fire trading and had a view on the market and view on every wiggle that the stocks market is doing and so on, he never touched these companies. And the reason these companies did well was that they were great businesses.
So some of my biggest takeaways are, even though Rakesh did a lot of active trading, which Mohnish reckons was just to keep his mind occupied, most of his gains were the result of buying 2 high quality compounders. I was having a look at Titan's price, and since 1999, Titan's compounded by around 34% a year. And based on what Mohnish said, I'm pretty sure Rakesh bought it even earlier than that. And in order to enjoy Titan's massive run, he also had to endure the volatility that went with it. Another key factor behind Rakesh's success with Titan was not selling the stock after it went up significantly. Rakesh could have easily sold Titan when it became a 10-bagger or even a 100-bagger, but he held on and basically allowed the snowball to continue rolling down the hill, even when it became 40 or 50% of his portfolio.
And the reason these companies did well was that they were great businesses. And he never sold them even when they looked optically overpriced. So Titan became a market darling. Everyone loved Titan after 20 years. They understand the story really well. And it's like Costco. You know, everyone understands Costco, everyone loves Costco or Walmart and so on. But so one of the important things in investing, which, you know, is a departure from Ben Graham. While Ben Graham is regarded as the father of value investing, he also did, in my opinion, some disservice to us value investors. Because Ben Graham had an edict that was cast in stone. And the edict was that a stock should not be held above its intrinsic value. And actually, with due respect, and I hope you will pardon my blasphemy, the correct model, I believe, would be like the Buffett, Munger, or Chuck Akre model, which would be like Chuck Akre is a great example, and I think maybe you should see if you can get him to speak to you guys. Chuck Akre asks a question. He doesn't ask the question, is the stock above intrinsic value? He asks the question, is the business getting better? And if the business is getting better, then you need to give the broader room. And so while you would not buy Titan at 50 times trailing earnings or 40 times trailing earnings, maybe even 30 times trailing earnings, you should not sell it. So there is an asymmetry in investing, which Ben Graham didn't talk about or probably even didn't believe in, where at a certain price, I would not buy a stock, but I wouldn't be wanting to sell it. And so I think that when we make investments, so this asymmetry, you know, between what price you would buy a stock at and what price you'd be willing to sell a stock at. So let me take a slight detour. The very nature of capitalism is that if someone has a great moat and is making supernormal profits, there are lots of incentives with lots of entrepreneurs and businesses to go into that business and wipe out those supernormal profits. That is the nature of capitalism, which means that something like Titan going for 30, 40 years, Costco going for 50 years, or Walmart or Southwest Airlines, these anomalies should not exist in capitalism. If you just took a theoretical point of view, these anomalies should not exist. But they do exist. So enduring moats are very hard to predict when you start. But what happens in capitalism sometimes is when you look back, you can identify enduring moats that somehow got built and even look like they might persist for some time. And those are the ones to focus on. So one of the reasons the index is so hard to beat. So there are literally just about 4 or 5% of companies that generate almost all the returns that the index gives you. In the stock market, if you took out those 4 or 5% of companies, the market returns would be terrible. When we as individual investors are picking stocks, the odds are stacked against us because you have to pick 1 out of 20. And the odds of being wrong, and especially, you put on a cheapskate hat and you're trying to buy something cheap, and then you're trying to pick one of these 20 great businesses, cheap. Good luck with that. Very hard to pull off. And the index does so well because the index is too dumb to know that it owns Google, too dumb to know that it owns Microsoft, too dumb to know that it owns Costco, and too dumb to sell these things ever. And so it just rides these things. So just like we saw with Rakesh, 3% of his portfolio, which was a really small piece, which was probably at that time maybe worth less than $50 million or $25 million, becomes $2 billion. Okay. And what did he do? The biggest thing he had to do was do nothing. So the holy grail in investing is we will make a lot of mistakes. John Templeton said that the best investor will be wrong 2 out of 3 times, 1 out of 3 times. Most of us will be wrong half the time. Even if you're wrong half the time, you can do really well. This is a very forgiving business. But the important thing is that when you find yourself in the happy position of ownership of a great business, you have to set aside Ben Grant. And if you can see the runway and you can see that it's a great business and it's going to keep growing, keep doing well, run by great managers, honest managers, then you just hang on to it for dear life.
When it comes to buying stocks, I think Graham's advice is still very relevant, even for investors who are trying to buy long-term compounders at a fair price. But Graham's advice on selling a stock is where it gets a little blurry, and how you go about it kind of depends on what style of value investor you are. According to Mohnish, if we want to be part owners in these great businesses, then one needs to cast aside Graham's teachings on selling a stock above its intrinsic value. If you look at some of the great compounders, like the Costcos and the Titans, after a while, once it becomes clear that they're a great business, they usually become very expensive. And by selling a great company when it becomes fully valued or overvalued, you could potentially miss out on these huge runs where the big returns are made. He also mentions Chuck Akre, who has a similar investing approach of looking for multibaggers. And he says Chuck asks the question, is the business improving? Instead of asking, is the business overvalued? If the business is improving and there's a lot of runway left, then if you're a long-term investor, the wise thing to do is to do nothing. So even though you might not buy Costco at the current price, you definitely wouldn't sell your ownership in Costco at the current price either, which is similar to something Charlie Munger said recently as well. So overall, I think Rakesh is another good super investor to learn from. And I was thinking of doing a full video where, similar to what I did for Nick Sleep, I go through some of Rakesh's greatest investments like Titan to see if we can take any good lessons that can help us with our own research. So that's a quick introduction to Rakesh Jhunjhunwala, and I hope you found it interesting. If you did, please consider hitting that like button as it really helps the channel grow. And if you watched the video all the way to the end, thank you so much for watching. If you're still bored, I'll put another video up in the corner that I think you'll find interesting. So that's it for this video. Thank you so much for watching, and I hope to see you guys back in the next one.